China's economy has hit a significant bump in the road. During the 3 months leading up to June, the nation's economic growth slowed to just 4.3%. This represents the slowest rate of expansion the country has experienced since late 2022. According to reports from both NPR and The Guardian, this figure came in worse than expected, missing the government's official target. This slowdown signals a major shift for the world's second-largest economy, raising urgent questions about its future path and what is driving this sudden deceleration. To understand why this is happening, we have to look at two competing forces within the Chinese economy. On one side, NPR reports that strong exports have provided a much-needed boost, driven in part by a global boom in artificial intelligence technology. However, this export strength was not enough to save the quarter. NPR highlights that lagging consumer spending and weak business investment actively offset those export gains, dragging down the overall numbers. It is a classic push and pull where domestic weakness is overpowering international demand. Different media outlets place their emphasis on different aspects of this economic miss. While NPR focuses heavily on the internal tug-of-war between strong artificial intelligence exports and lagging domestic spending, The Guardian shines a spotlight on the official government targets. The Guardian reports that the 4.3% growth rate fell short of the government's target of 4.5% to 5%. Furthermore, The Guardian points out that this rate is one of the weakest quarterly readings since China began reporting official quarterly gross domestic product figures back in the early 1990s. What the collective coverage underplays is the deeper structural concern of a lopsided economy. While the reports mention that exports are booming and domestic spending is lagging, they underplay how risky this imbalance is for China's long-term stability. Relying on global artificial intelligence demand to prop up the economy cannot permanently mask deep-seated domestic issues, such as hesitant consumers and cautious businesses who are holding back on spending and investment. This lopsidedness suggests that the economic engine is running on only one cylinder, making it highly vulnerable to external global shifts. Ultimately, the sharpest takeaway is the historic scale of this slowdown. We are not just looking at a minor quarterly miss, but one of the lowest economic growth rates on record for modern China. With a growth rate of roughly 4.3% against a target of about 4.5 to 5%, the country is facing its toughest economic climate in decades. Without a rebound in consumer confidence and business investment at home, China's reliance on technology exports may not be enough to pull it out of this historic slump.